November 20th, 2023. We had two open gaps earlier in the day today, and that's really important. That oftentimes leads to trends. We had one gap here with the 9 high and the 40 low. And the other gap we had was really subtle, but there's an open body gap right here that is kind of hard to see. It's only a tick, but you can see basically the close of bar 5, and then we got a breakout, and the closes here do not overlap these closes. And the reason that's an important gap is it's more visible on line charts. A lot of institutions trade line charts, and so they'll see this as an open gap. And you can see here, it is in fact an open gap. And so when you get open gaps on line charts, you consider them body gaps or negative gaps, whatever you want to call them. And then we got the second open gap here. So when you have two open gaps early in the day, a lot of times that will lead to a trend, and that's what we ended up getting today. I have a couple examples. Just basic couple of early open gaps. We got a trend. This was today. A couple early open gaps. We ended up getting a trend. Came back down, but we ended up getting a trend. A couple early open gaps. We got a trend. So you can see it's pretty common when you get early open gaps to end up getting some sort of trend. Additionally, what I thought was really interesting was the low of the day. Well, there's a 20% chance that any given bar is going to be the low or the high of the day. But you can see the actual low tick of the open of the day basically the open of the day was the low of the day. And the open of the day is only the low or high of the day, once or twice a year. And it happened like a month ago. So I'm kind of actually surprised that it happened again today. These charts that we all look at are sampled data. They're not, actually tick for tick what's happening. So sometimes it'll show that it's the low of the day, and it's not actually, there'll be like a one tick tail below this on the CME charts, which are the actual CME futures. So the way to look and see if it's actually the low of the day is you look up CME futures. You click on the CME group. You go to markets, the Emini, and then I usually go quotes, and then the most recent one, chart, and then I usually use a bar chart, 5 minute, and you can see the open of the day today right here was in fact the low of the day. The low 45.2450, and the open was 45.2450. So the open of today was actually also the low of the day, which I thought was interesting. But it's a low probability thing to happen. We got when we got a big bull bar on bar 1, you should immediately be thinking about the weekly chart. At least I thought that was important today, because last week's high, there could be buyers above this high, and I thought that traders would want to know what was up there. So I thought there was a pretty reasonable chance we were going to get above last week's high, which was right here. And I thought first, obviously we have to get above yesterday's high, but I thought if we got above yesterday's high, we were pretty quickly going to go to get last week's high. And so one big bull bar closing near its high, a lot of bulls will buy for a scalp, betting that we're going to get to last week's high. And you can see once we did get to last week's high, a lot of those bulls ended up taking profits, and we got a pullback. And then 3 again tried to break out of last week's high, but it failed again. And then we got bar 4, a bear bar. It's an inside pattern, so we got an II. But we end up trading above. Generally, when you get an II, 50% chance we're going to break it to the upside, 50% chance we're going to break it up to the downside. After these 3 bull bars, maybe it's slightly higher, but it's still the open of the day, so you have to be really cautious. And then we got bar 5, looked like a failed breakout attempt of the II, and then we got a big bull surprise on bar 6. Bar 6 looks climactic, and you have to keep in mind that this is probably an exhaustion gap because this is a climactic bar, and the bottom of the biclimax is here, so it's pretty reasonable to think we're going to test the bottom of the biclimax and essentially form a trading range within this range, which is exactly what we ended up doing. So big follow through for the bulls on 6. Can you buy 6? I think you can, but you have to realize that you're probably buying the top of a trading range. It's probably always in long, but if you're going to buy above 6, you have to have a really wide stop and probably be willing to scale in. So kind of hard to do to want to buy up there, and that's one of the reasons why there are not as many buyers up there during 7. Additionally, any of the bulls who do buy above 6 during 7 are disappointed, and a lot of them just scalp out around even during 8. And that's the reason why you get this big tail on the top, because they don't want to sit through this big pullback that they know is probably coming. If they're buying above 6, they're hoping that they're going to get another explosive bar to the upside like 6, and that they're going to be in really early on what's going to be the start of a really parabolic move. They know it's probably not going to happen, and so when they get disappointing follow through, some will scale in lower, and then they'll scalp out around break even on their first entry with profit on their second entry. Outside bar on bar 9, it's it's not a strong close, but you have to keep in mind, we haven't traded below a prior bar yet today. So we have an 8-bar bull micro channel. So do you really think that, it could be a parabolic wedge, but do you think that selling below 8 is going to be a good idea? Probably not. It's an 8-bar bull micro channel. It's a tight channel. We're probably going to get a second leg, sideways to up. So most likely we're going to go sideways here and not down. We got an outside down bar on 9. So the first bar to trade below a prior bar. Doji bar on 10. So we're now forming a tight trading range from 7 to 10. And tight trading ranges are always going to be magnets. So we try to get a breakout of the tight trading range on 11. But even if 11 closed on its low, there's a lot of problems with it. It's trying to break out of a tight trading range, so lower probability. And the channel up is pretty tight. So again, lower probability. So really not all that great selling anywhere down here. Additionally, you're selling right on the moving average and you're selling the bottom of a buy climax where there's probably going to be support. So that the middle of this tight trading range is going to be a magnet, and that's exactly what's happening on 12. We get pulled back into the middle of this tight trading range, so we're going to continue to go sideways. Bad follow through for the bulls on 13, which is somewhat to be expected. Buying above 12 for a second leg, you could maybe do it, but after 3 straight bear bars, I thought it made more sense to just stay flat and see what happened. I thought there was actually a pretty reasonable chance of some sort of midday reversal forming today, since this wasn't the strongest move up, but 43 pretty much changed the entire day. 15, a good bull bar closing on its high. It's a shave bar. Can you buy above 15? I think you can, but you're buying the top of a tight trading range, and it's pretty hard to want to buy above 15. I think that it's better to wait for follow through, but the follow through you get on 16 has a tail on the top, and so it makes you wonder if you should be buying that high. Again, a kind of bad follow through on 17, a doji bar, and then a good bull bar on 18. You can buy above 18. It's, you can look at this as a spike and then a channel, and then a trading range. So let's do it this way. Spike, and then the channel. I'm going to just make this a different color. Sure. And then the trading range. And the market cycle, or the market is constantly repeating the market cycle. That's not going to work. The market is constantly repeating the market cycle because it happens again. We get a spike here, and then we get a channel up, and then we get a trading range. You could say this is the trading range. Some would say, this is the spike, and then the channel somewhere in here, and the trading range starts. It's kind of fuzzy where the trading range starts, but you can see this is happening again. You get a spike here, and then a channel, and the channel ends up lasting longer than you think. A lot of times it turns into a trading range, but here we got a spike and a channel and a breakout above the channel, and now we're testing back. You can see here to the bottom of the channel, and it's forming a trading range. So spike, channel, trading range. So the market is constantly in a state of spike, channel, trading range, spike, channel, trading range. Point being, you can buy the close of 18 or 19 expecting a second leg up, and you're expecting to hold for a bull channel. If you're buying up here, you're expecting that you're going to get a pullback. It's going to be sideways for a little bit, but you're overall expecting a second leg up in the form of some sort of channel. So you can't buy 18 and 19 and just be, disappointed with 20 and expect, you have to be expecting 20 essentially. If you're buying up here, it's probably not going to just continue to rally straight up. So you get bad follow through on 20. Can you exit below 20? I don't think if you're buying up here, you should exit below 20. It's a small inside bar. Some bulls might, but after 5 straight bull bars, it's definitely reasonable for always in bulls to continue to hold long. Bad follow through on 21, outside up on 22. We're starting to form a tight trading range. It could be a final flag for the bulls. 23, a doji bar. 24, an outside doji bar. It's a 2-legged correction, so 20 and 21 is the first leg. 23 and 24 is the second leg. So we might try to resume to the upside here, but again, this is a tight trading range late in a bull trend, so it could be a final flag, and we could start to go sideways here. You get a bull breakout on 25, closing at a new high. So some bulls will buy. Always in bulls can buy above 25, hoping for a swing up, but they know they're probably going to be disappointed, and they're probably going to have to exit with a small loss, most likely, and that's what ended up happening over here. And actually, I have when 25 closes strong. Where can you pull your stop to, right? If you're an always in bull, one of the concepts is when you get a bar. So let's say you bought the close of 2, right? And your stop, if you buy the close of 2, is below 1. and then you continue to rally, you get a pullback, and then you get a rally. So on the close of 16, you can put your stop here because it's the next major higher low. And then you continue to rally, you get a pullback, and you get 25 closing at a new high. So now you can put your stop here because it's the next major higher low. And you can see what happened on 40 is it traded exactly to that stop and stopped out a lot of always in bulls, and then immediately started to race up, and bulls were scared that they just got trapped out of a really good trend. And so that's what's causing all of this buying is the bulls got trapped out right here. The bulls were hoping that they were going to get this sort of rally, but they wanted it to happen over here. They were disappointed in here, and so a lot of traders were thinking, well, I'm going to get out maybe below 37 consecutive bear bars and look to buy again above a good bull bar. But you can see they weren't really given the chance. They getting a dramatic spike up, and they were forced to buy a lot higher. And we ended up going, for more than a measured move up of that spike, and that'll happen sometimes. But point being, some bulls will buy above 25. They know it's lower probability, trying to break out of a tight trading range. 26, kind of bad follow through for the bulls. 27 trades below 26, but buyers below. 28, you could say, down, up, down, up. So you could say two legs down, 27, 28, and a reversal up on 29. Bad follow through on 30. It could be a double top. Probably, better to just continue to hold long if you're still long. I think it's okay to hold long if you're an always in bull. I'm trying to get better at talking from an always in perspective, since it's the most basic form of trading that, I'm doing. It is the form of trading that I'm doing, but it is overall the most basic form of trading. So stop below here, continue to hold, and you get a breakout on 32 and 33, but it looks like it might just be a breakout of a bull channel, and it's probably going to fail within a couple of bars. And that's kind of what ends up happening on 34. Anyone who's buying closes up here, kind of gets disappointed with 35, and a lot of those traders are exiting, causing 36. Some traders might exit below 36, but I think it's okay if you're an always in bull to continue to hold, but you probably have to exit below 37. It's right on the moving average, and it's probably going to be a minor reversal, and you're in a trading range overall. But I think it just makes more sense to get out and look for something else. At this point in the day, I thought that we might end up getting a midday reversal, but it didn't. It obviously didn't end up happening. And what changed my perspective on the whole day, obviously, was 43. I wonder if it just went right up to the measured move. That's kind of funny. So 43, right? This is a wedge pullback 1, pullback 2, pullback 3. And a lot of times when you get wedges, you get measured moves of the wedge, right? So you get a wedge pullback and then a breakout to the upside and a measured move up. And a lot of traders bought the breakout, hoping, thinking 60% chance we were going to get the measured move, and we ended up getting it. So bad follow through on 38 and a second leg down on 39. This is probably going to form some sort of wedge. I was looking at this at the time as a trend line break, and I thought what was going to happen is we might get a trend line break and then some sort of maybe lower high or higher high retest, and then a potential major trend reversal. We've been going pretty much sideways for about 20 bars, a little over 20 bars. So I thought the probability was pretty neutral. So I thought we could get that, but it was also obviously possible for us to get a second leg up. And then we get a huge bull surprise on bar 43. To me, 43 changes, the character of the day entirely. I don't know if there was an announcement or something. It's unusual. Usually when you get bars like this, they're from announcements, especially in the middle of the day. And I looked at CNBC after, I just went on their homepage and just was looking to see if there was any sort of announcement, and I didn't see anything. So I don't know if there was, but good bull bar, and regardless, doesn't matter either way. Good bull bar on 43, bad follow through on 44 doji and 45 doji. And it could be spike, channel, trading range, right? So it could be spike 43, channel 44, 45, trading range 45 or 46, 47. So again, the market cycle is cycling within itself constantly. It's happening constantly. But, it's important that we didn't end up getting a bear close on 44. It made it a lot more likely that we were going to get a measured move up when we did not get a bear close on 44, because it means, a lot of traders were accepting the higher price. Even though it was a doji, it's not great for the bulls, but it's a lot better than if there's a bear close. More follow through on 45, 46 trades below 45, but after this, you're expecting that first reversal down to fail, which it does. 47, bull bar closing, above its midpoint, but not quite at its high. At this point, if you're a bull, you can buy breakouts. It's clearly always in long, so you can pretty much buy any bull close. follow through on 48, 49. You can buy, the close at 48, 49. This could be a parabolic wedge, 1, pullback 2, pullback 3. So it could be a parabolic wedge on a lower time frame. Probably going to go sideways, but okay to be long. And the same way that always in bulls got trapped out here, when you get a big bear, I'll get there in a second actually. So here's what I thought. I thought, good bull spike, pull back, and we ended up getting a channel on 51, 52, pullback 53, another bull bar 54. But if you look at this, it's 1, pullback 2, pullback 3. So potential wedge top at 55. Now, 55 is not a good sell. If you notice, we didn't trade below a bar. We traded only at the lows of bars, not below bars for 10 bars. So the first reversal down was likely to fail. So we got the first reversal down at 55, which was a wedge top, but it's in a tight bull channel, so probably not a very good sell. And then we got 56, a bull bar closing near its high. I thought it was valid to think that we might try and get a breakout above the wedge and continue up, but we got disappointing bar on 57. When you get 57 as an always in bull, it's kind of hard to want to hold. It's a trend line break. We might start to sell off here and test the bottom of the channel. So I think that a lot of always in bulls exit below 57. But bears get bad follow through on 58, and then you get a bull bar closing near its high on 59. So all the always in bulls who just exited are now trapped out. So the same way you had bulls trapped out here, you now have bulls trapped out here. And keep in mind, the whole premise behind open gaps early in the day is that you're getting trapped traders. So you have bears who sold above this high who never got out of break even. You have bears selling breakout points on line charts who never got out of break even. So the whole concept of gaps is you have trapped bears here. And now here you had bulls trapped out and we continued up. And here you have bulls trapped out again. So it's reasonable to buy, if you're an always in trader, reasonable to buy again above 59. You get bad follow through on 60, but still okay to be long. Breakout to the upside on 61. Some bulls will buy the breakout. Follow through on 62, inside bar, buy the close bar. Follow through on 63, buy the close bar. It's getting pretty climactic at this point. You're getting later in the day. So what a lot of traders will start to do when it gets late in the day is they'll start pulling their stop, below every bull closing above its midpoint. So, for example, you get 63, you put your stop below 63. 64 doesn't close above its midpoint. So I wouldn't put a stop below 64. It seems like a bad idea. Probably buyers below, pretty tight bull channel. You can see we immediately got buyers below on 65. Bulls eager to get in on the bull trend and buy below the first bar to trade below another bar. Doji on 66. So we do have 2 doji bars. And generally when you get doji bars in a buy the close rally, the rally is going to end within 3 bars and start to go sideways. And then you get 67, a bull bar, but not quite closing on its high. And 168 trades above 67. You can pull your stop below here. Especially 168 closes strong, you can pull your stop below 68. 69 closes strong, you can pull your stop below 69. And then you get bad follow through on 70. And I think a lot of traders exit below 70, and that's why 71 closes so strong. Now, it's a tight bull channel, so you know that this first reversal down is probably going to fail, and we're going to get another leg up. And then when you got 72, a lot of traders were disappointed in this enough so that they were exiting around break even. Think about if you bought this close, how you feel about this. Not very good. And so, you could argue 70 is 1, pullback 2. So it's a 2-legged correction here and then another leg up on 72. But bulls, it's late in the day. If we were going to race up to some sort of magnet, we probably already got there since 71 closed strong. And the magnet I thought we were going for, I was watching on SPY a lot of the day, but the magnet I thought we were going for was this low because limit order bulls bought below here and never had a chance to get out of break even. So I was actually kind of surprised when we got 71 and those traders were not let out at break even yet today. But you have to trade the chart you have, not the chart you want. So you have to get out. And this is why, because it's towards the end of the day and traders will start to exit their longs. This is kind of a gap bar technically, so I wouldn't be surprised if we test back to the 75 low tomorrow morning. When you get a bull trend day, there's a 75% chance of 2 hours of sideways to down trading starting, by the end of the second hour the following day. So tomorrow I am expecting mostly sideways trading, and I'm expecting us to probably test this low. And I wouldn't be surprised if we tested above that high and got to that magnet I was just talking about. For always in, maybe 1, but I think better to wait. Maybe 6, but still probably better to wait. Again, maybe 15, probably 18 or 19 are good by the close bars, but you're probably going to go sideways. Probably 25. 33, pretty much any bull bar is closing near their highs. And then once you get this, you can buy the breakout, you can buy the close, you can buy the close. You can buy breakouts above bars. As we break out above 54, you can buy. You can buy above 59. You can buy the closes of any of these bars, but you should be bringing a stop right along with you, because if you're buying the closes up here, your premise is that we're pretty much going to rally straight up. You don't really want to be sitting through pullbacks in these late day rallies when we've been going up all day, because usually when you're going up all day, there's a profit taking rally or profit taking sell off at the end of the day. And that's exactly what was happening here. On the daily chart, good follow through for the bulls. This high one got a surprising amount of follow through. This has been one of the strongest, fastest rallies I've seen in general. I mean, we went up, we're up probably 10% in, like three or 4 weeks. That's really, really fast. Go up 400 points that quickly. We're probably going to break above this high and see what's up there. I don't know if we do it before we pull back. I've been thinking personally that we're going to have a pullback since somewhere down here, but sometimes, by the close rallies, these things just happen where it just continues up. And that's why it's okay to buy. I mean, on the day, you saw it today in the daily chart or on the 5-minute chart, it was more likely that we pulled back for a lot of the day, but we just continue to rally. And that's what happens sometimes. So that's why, with It's Always in Trading, it's good to establish a position and not get out until you have to. I still think we're probably going to pull back pretty soon. We might have to get all the way up here first and see what's up there, but I still do think we're going to see some profit taking relatively soon. This is the top of a trading range, right? And this was probably strong enough for a second leg down. So I don't think this is going to rally straight up. I think we're going to go sideways and get maybe a 50% correction, maybe not quite that deep, but I'd be interested to see if we were able to close this gap, and then we're probably going to get some sort of second leg up. That's the day.